The market doesn't know what keeps you up at night. It doesn't know when you want to retire, and it doesn't know how old you are. The simple truth is, the market doesn't care. But if you care, you've tuned into the right place. You're listening to Investor Resources, bringing clarity to the confusing world of finance. Here are your hosts of Investor Resources, Don Creech and Perry Sykes.
I'm Don Creech.
And I'm Perry Sykes, and welcome to the Investor Resources podcast.
So there is a change going on in the financial services industry. Been watching the markets lately. There's lots of change going on there.
It changes all the time. That's right.
It's a very dynamic environment, and it's not just whatever you may be doing in your portfolio or your manager doing for you, but it's also industry-wide. The default mechanism for investors has long been the use of mutual funds. And that industry is suffering massive outflow of client money. Part of that has been innovation, because the old mantra has been buy and hold, don't worry about the market, park it with a mutual fund. They have good long-term management track record. They've got management teams. They've got people all around the world. They are the smart money. They know how to manage money for you. Just don't look at your account if things aren't working well, because eventually we'll straighten it out.
And they make it difficult, to look at your account anyway. Inside of mutual funds, they don't want you looking anyway either. They want you to just leave them alone also. So they don't do much in the way of reporting. They're very opaque. It's very tough to find out what's in there. And they're just running up against better products. Like you said, Don, new innovations that are out there, and the mutual funds aren't changing. They've been a cash cow for decades, and there's trillions of dollars there, but they're just getting known. They're not attracting any new money. The new money is going to exchange traded funds away from the mutual fund model. They're just too out of step with what's available in the market.
So you said they've been cash cows for decades. Actually, this goes back almost a full century, because mutual funds were really introduced in the 20s. So we take now, it's basically 100 years. And prior to Charles
And by the
Schwab,
way, we were not managing money at the time. We've read about this. So, yeah.
We have some gray hair, but it's not that great.
Not that great.
So prior to Charles Schwab introducing discount brokerage,
right,
being an individual investor was expensive. The information you needed to make good decisions was expensive and hard to come by. In fact, you really kind of had to have a broker who really liked you to get that information, because the Wall Street firms controlled it.
They had it all, and it was not public, right?
And Charles Schwab said, I think there's a better way to do this when commissions were deregulated. So back in the mid 70s, he started a discount brokerage firm. And the consensus was, who's ever going to do that? He'll never survive.
Nobody worried about Charles Schwab. It's like, they're never going to make it anyway. That's impossible. They need to pay us for this information, or it's going to collapse. Didn't quite work out that way.
Yeah, it didn't work out that way. And now what we have is, actually in the mid 80s, the first exchange traded fund was introduced. It was on the S&P 500. I don't think it was called the SPY at the time.
It was not, no.
And you did have to buy it through a broker, and you paid a commission to get it, not like today. But that began the development of looking at an alternative way to participate in the market. And that side of the market, that arena of investment choices has just ballooned. And investors have kind of fallen into two categories. The ones who don't want to be bothered with anything, buy and hold, close your nose, close your eyes, and just kind of wait until you finally need the money in retirement, and everything will be coming up roses school of thought.
Right.
Unless, of course, you come up into retirement at the beginning of the tech bubble collapse, or the mortgage bubble collapse. It's buy and hold has a different nuance to it. in a bear market.
Changes
And
everything. Yep.
that's kind of what's driving the current exodus from mutual funds today. The choices to go to exchange traded funds where you have more control from a tax standpoint, and you can decide to do one of two things: manage it yourself, hire a manager to manage the funds for you, or you just simply buy very low cost index funds, which is how they all got started. And
Correct.
until recently, that still dominated the exchange traded fund arena. And the end of the bull market from the early 80s has really challenged mutual funds because theirs is primarily a management model. We have active managers, we're making good choices, just trust our research. Look at our mountain chart from 1929. See how good we've done since then? You just stay with us long enough. You say, well, yeah, but I'm already 50, so I don't think 70 years is going to do me any good. Yeah, well, that doesn't really matter. We're a good company and we've got good. Look at our sales material. It's just beautiful. But
And
investors,
John, that was the bulk of their advertising. It was the just trust me age. Just trust me. Trust me. We know what we're doing. We know better than you what's going on. We have the data. We've got people on the ground in every major economy on earth. We can do things you can't do. And that just all changed. All their data became publicly available to everyone. Everybody was working off the same page now. And it was like, oh, wait a minute. You guys don't have any magic crystal ball on what's going on here. Not to mention, you're kind of expensive. Not to mention, we get no input as to what goes on with our money. Why do we need to do this again? And it was for years and years. Recently, it's just been inertia. That's where you started investing. That's where individuals would put their money. That's why there's still over $22 trillion out there in mutual funds. There's a huge amount of money, but there's no new money going in. And everything there's outflows from mutual funds because they're just too expensive and restrictive in their form. You don't know what's in them. They cost too much money, even though their fees are coming down because exchange traded funds are so much less expensive across the board. But it's not enough. It's too little, too late. It's just not a good product compared to an exchange traded fund. Exchange traded funds trade like stocks. You inherit no one else's capital gains. You don't get the phantom capital gains from exchange traded funds 99% of the time. And so it's just a far superior product. The biggest problem was anybody who sells mutual funds, no one wanted to change. There was too much money to be made there. It was a huge channel for income and cash flow into those firms. They didn't want it to change, so they didn't exactly market against themselves. They just quietly opened ETFs in every category that they had a mutual fund. And if you found your way over there, you could buy it, but they were never going to promote it. And that's finally turned the corner where people don't pay attention to the mutual fund market anymore. They're not bringing any new ones out. People want exchange traded funds. It's such a superior product.
well, and the mutual fund companies themselves are losing massive amounts of revenue as the client money exits. So does the fee revenue. And so
That's
the
it.
advent of mutual fund or exchange traded funds as well will sponsor ETFs, but the fees are so low that's not really solving the cash flow problem that the mutual fund families have. And so
Correct.
they're looking for other accounts. And we've talked about this in prior podcasts, is that unlike the 70s when people didn't want to buy mutual funds because of the bear markets that happened
Right.
in 69 and 74 and so on, they turned to limited partnerships. These were the
Right.
new, better ways, and the fees were much higher, and they were opaque. They were hidden. I mean, if you read the 300-page prospectus, you might figure it out. But
If you're
nobody
going to
ever
have
read.
fees, you might as well be able to hide them, right? I mean, that makes sense, right? So,
So now we have the alternative
uh,
investments. Let's invest in something else that isn't the
yep.
stocks, or we're going to do it in a different way. And by the way, the fees are going to be much larger, and liquidity may be a problem. So if you need your money out at a given time, maybe not, maybe not.
Could be an issue. Yep, could be an issue.
But the issue is, let's see what we can do to raise the revenue coming into the mutual fund management company. And many of these have gone out and purchased other manager firms that specialize in unique parts of the market in the alternative space. And they're finding that that really hasn't turned their revenue around. They've done so at the time when the market has become very, very difficult to finance new deals, to find a deal that makes any sense. You have small companies that are
Right.
on the verge of going bankrupt because of the current interest rate environment. I mean, it's not that the economy is in the tank. The economy is kind of chugging along and doing okay, but the financing options, the way of putting together a couple of companies into a bigger entity or a more efficient entity is just a lot more difficult than these fund companies expected. And it turns out in the end that most of what they have actually accomplished is due to a 40-year bear market rather than managers actually generating net gains because they were so much smarter than Mr. Market himself.
It was the
And
bull market. It was the bull market that ran that up, right?
and now they're faced with a bear market and clients saying, "Hey, look at interest rates at 5%. You know, why take the market risk?" And so we have this alternative drain on capital, and bull markets need new money. If there's no money flowing into the
Yep.
market can't go up. It requires buyers, enthusiastic buyers, as a matter of fact,
Yep.
and
You
they're
got to be
pretty hard to
attracting
find
cash.
today.
That's how you hit new highs. You get the new money coming in, and it continues to new money follows the old money, and it just keeps growing. And right now we don't see that. There's too many things causing too many people to have second thoughts about even being in the market at all. Like you said, Don, if you can make 5% and take virtually no risk, that's close enough right now. It's like, okay, and it gets me out of the crazy market right now. I'm going to do that, and there's a lot of that right now. That makes new market highs very, very difficult to find.
Well, in the accounts that we manage, we have a lot of that cash ourselves in the account, just simply
Sure.
because we view the risk of the current market to be abnormally high.
Quite
The
high, you bet.
return potential for being fully invested in the market as a buy and hold investor is not very attractive. And it's what's called the risk premium to be in stocks instead of in a conservative cash alternative account is about
Correct.
1%, which is about 25% lower than normal. Well, that tells you that on the opposite side, risk is much higher than normal. So for those who are optimistic buy and hold investors, it can be a long hold before you get that return
Yep.
deposited in your account. One of the areas that really hasn't changed much is in the pension plan. The 401k business is still dominated by mutual funds. And you mentioned
Right.
the difficulty of liquidating or changing. We have clients who have their own 401k at their company, and we give guidance to those people. And we are constantly getting emails that say, my 401k account won't let me make a change in this asset for 90 days. I have to buy it and hold it for 90 days. Well, if it's market's tanking and you want to be in cash, it's kind of like, too bad, Charlie.
That's it.
Reminds me of the old Starkist tuna ads on TV. Sorry,
Uh,
Charlie.
all right, Charlie, you get nothing. And that's a long time in today's market. 90 days anywhere. That's a significant time frame to lock somebody into. But again, that's the 401k market in some cases.
So we switched our accounts to ETFs, well, some time ago. The other alternative that came to market to help solve the cash flow problem at the fund company was
Yep.
separately managed accounts, SMAs,
Correct.
or TAMPs, as they are sometimes called. But and so we were using those in the early 2000s. But when the market tanked in '08 and '09, even though we had ETFs in our account, we were using SMAs. We farmed out management.
Correct.
But managers didn't do anything when the market went down because their view is long term, buy and hold. You just simply hold your nose when the market goes down, and you don't take money out of your account regardless of your age or circumstances, because that will hurt
Right.
the recovery. We said this doesn't make any sense.
Right. Their primary job was thinking of great things to tell your clients to keep them invested. That was it. Find an excuse for why we're still in this ridiculously bad market. And that just wasn't good enough for us. We're fiduciary managers. And if we're going to look out for someone on the downside, you have to be willing to be nimble enough to make a move when it's required. Knowing full well you don't know how long that move is going to be good for, but you know it needs to be made. And the managers, the money managers out there just wouldn't do it, and we had to take control of that back ourselves.
So we did that in beginning in 2010, and here we are 13 years later. But markets are a challenge. Clients have to, investors, whether they're our clients or not, they have to make a decision. Are we going to pay attention to what's going on, or are we just going to park the money and trust that that mountain chart that I saw when I first opened my account is still valid, and it will turn out to be at a high point when I retire or need the money?
Right.
And that's
Yep.
a real act of faith. Faith isn't what's going to make your account grow. Our view is watch what's going on. Somebody has to pay attention. You can do it. You spend a little bit of money on data, a charting program, and pay attention to the account. Spend a few years learning how to do it. It'll take that. Or you hire somebody who actually pays attention to the account. But you just mentioned, Perry, what the primary business model is. The business
Yep.
model in financial advisor world is hold the client's hands so they don't leave the market, but just get them through it no matter how long it takes. Most advisors do not actively manage their accounts for clients. They park them in a model and tell them everything will be okay. Just keep the faith, brother. And
keep your account here. Yeah. Don't ever move your money. Yeah. That's it.
So, well, that's probably a good place to wrap.
That's a good wrap.
Well, pay attention to our postings. We'll have more coming your way. If you haven't subscribed yet, we appreciate you doing so. Have a good day.